Okay, good morning, everyone, and welcome to this morning's Coffee Microcaps Morning Meeting. You're all very welcome to this morning's meeting. For anybody who doesn't know me, I'm Mark Tobin and the founder of Coffee Microcaps, and you're all very welcome, whether you're a regular attendee with us here or you're joining us for the first time. I'd like to start off by just mentioning our sponsor here, RAS Research as a Service. If you are looking for institutional grade research of some of the smaller microcap names on the ASX, please do check out their website for some research, which can be hard to find on these names in general. Quick compliance and disclaimer slide. For anybody who is joining us for the first time, the companies we tend to have presenting on here, capped under 300 million, our definition of a microcap, in revenue, heading towards cash flow break even, or indeed are already profitable. We tend not to have companies here from the resources and biotech sectors, so what I like to call industrial microcaps. Structured this morning's webinar, we're going to have three companies presenting. Each company is going to present for plus minus 30 minutes, break that down into a 20-minute preso, and we leave 10 minutes for Q&A at the end. If you do have any questions for any of our presenters, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate them to our presenters. And please note the webinar is being recorded and it'll be posted on the Coffee Microcaps YouTube channel on Monday. Follow us pretty much on all of the socials. Twitter's our main one. As I said, YouTube for this recording, and indeed all the other events we have happening in and around reporting season. Now we've got two more next week. We had one last week. LinkedIn, you can get us as well. And I write a free monthly newsletter you can get on Substack. We've got three returning presenters this morning. First up, we've got Dr. Chris Richards from Apiam Animal Health. Then we're going to head from Bendigo up to Brisbane. We've got Dennison Hambling from Intelligent Monitoring Group coming back to us. And then to continue our tour around the grounds, we will be in Melbourne for Paull Gillespie from Smart Parking. And without further ado, I am going to stop sharing my screen and hand you over to Chris. Chris, if you want to start sharing your deck, I'll let you know when I can see it. Yeah, I can see the cover slide now. Chris, you can take it away whenever you want.
All right, thank you, Mark, and good morning to everyone. Today I'm going to be talking about Apiam Animal Health, how we operate our business, our FY24 financials, and then I'll finish off with providing some insights into our outlook for FY25. If I start off with highlights. Our year has really been a transformational year for Apiam. Apiam is Australia's largest provider of veterinary services into the regional rural areas. When I say it's a transformational year, during COVID period, we made a significant number of acquisitions, and this year was really about consolidating and getting the synergies out of those acquisitions. And as a result of that, I've a diversified business model, and what we've been doing, we've been able to deliver resilient revenue performance. In terms of extracting synergies and trying to get operating leverage, that's been a big focus for the company, and as a result of that, we've got earnings growth during the year. Contributed by those synergies, but also a change in our operating model where we're now providing the clinics with a bit more autonomy to be able to be agile and provide services that are very much aligned to their local communities. That increased earnings growth is providing a very good cash flows, and our strong cash flows this year have been applied to reducing our debt. We've resumed our dividend and as well as applying to some organic growth initiatives. So I'll now just give a bit of an overview of FY24 from a financial point of view. Revenue of 204.8 million was up 6.2% on the prior comparative period of FY23. We continue to see gross margin expansion, and our gross profit was up 9.6% versus the prior year. And as I said, we're starting to get some real leverage, and that's flowing through to the underlying EBITDA, which of 20.3 million was up 22.3% on last year. We saw a corresponding increase in our underlying EBITDA. From an NPAT-A point of view, underlying NPAT-A, we had 12.3% growth, despite an additional 1.7 million in interest expenses. We are generating good cash, and our operating cash flow was 18.9 million, which is up 8.5% on the prior year. And as a result of that, our board is providing a final dividend of 1 cent per share, bringing a total dividends for the year of 2 cents per share. I'll now have just go through a little bit about our business and how we're operating across the veterinary industry. We currently operate 80 veterinary businesses or ancillary services, predominantly up the east coast of Australia, as well as some clinics in Western Australia. What's quite unique about these rural and regional areas compared to city clinics is that they service quite a large region, and a lot of our clinics are servicing regions out to sort of 200 or 300 kilometres, and that continues to expand as we see consolidation of the regional veterinary services. The revenue is split across two distinct veterinary models. One is what your typical vet model that you'd be familiar with in the cities, which comes under clinical vet services. That makes up about 80% of our revenue, and the other 20% or 22% is made up from the services that we provide into the intensive animal vet services. So just to look at that in a little bit more depth, our clinical vet services is very much your typical veterinary clinic. It's a business to consumer model, and it's providing services within clinics, but then it's also providing some clinics out in the field to our farming clients. Our intensive animal vet services is providing veterinary services, particularly through the use of technology and data analytics to commercial feedlot and piggery operators. So this is a business-to-business model. As I said, it made up 22% of our revenue in FY24. I'll now just drill a little bit further into clinical vet services. So, as I said, this is a typical veterinary clinic providing predominantly services to pets, but also to horses and other farm services. And it provides a full range of veterinary services and products to service all those animals in rural and regional Australia. What's slightly different to city clinics is that those emergency services and referral and specialist type services, we tend to do most of those within our clinics, and we operate a lot of those clinics under our flagship Fairlife Vet brand. In addition to straight dogs and cats, we also have some specialist and emergency equine facilities, which again are very much similar to a cat and dog clinic. They're just a lot larger in terms of the size of the tables and the equipment and everything like that. In our veterinary clinics, in addition to providing the whole range of services that you can see there at the bottom of the slide, we also offer a subscription-based wellness program or Best Mates program. I'll talk to that a little bit more in a minute, as well as products in the form of prescription products or pharmacy products, as well as retail products. If we look at how this segment performed in FY24, the real picture here is we were able to deliver resilient revenues despite the growth trends that are happening in relation to COVID pets, which are now in the healthy young adult stage of life. So, a lot of the spend in pets is in the first 18 months. They then sort of go through a 3 or 4 year period where they don't need a huge amount of or a higher amount of vet care. And then once they get to sort of from 4 years onwards, then that spend increases dramatically as they continue through their aging cycle. And so at the moment, we're really at that low point. But despite that, and despite the broader economic and cost of living issues, we've been able to deliver resilient revenue. This segment reported 7.4% revenue growth, and that was really driven by growth in this Best Mates program, which grew 32.4% in FY24, which gives us over 11,300 members. And what's quite unique about that is that, particularly during FY24 with the cost of living issues, is that all those members pay near on $800 up front as an annual fee to have access to those veterinary services. As I mentioned earlier, we have changed to a new model, a vet-supported management model, and giving that autonomy and agility to the clinics is really driving improved earnings margins. In addition to our portfolio of existing clinics, we've also been building new clinics, and over the last few years, and our 4 greenfield clinics have really started to ramp up in FY24. and they will start to deliver some really good growth, some positive EBITDA contributions in FY25. In addition to those acquisitions that we made over the COVID period, if we look at the acquisitions that we made in FY23 and FY24, we made some acquisitions the first month of FY24. We got 4.5% like-for-like revenue growth. So acquisitions are also performing very strongly. And in terms of our farm services, our pro dairy model has grown also extremely well, continues to expand and get market penetration into existing and new regions. If I now turn to the intensive animal services, and I said this is where it's a business-to-business model. It's veterinarians that are utilising technology and our data systems that we've invested in over the last few years to really drive our service and product offering. So that service and product offering being, veterinary consulting and veterinary advice, product sales, advanced diagnostics, including vaccine sales from our vaccine facility. If we look at how that performed, well, this has really been a transformation for this part of the business, and that transition to data-led veterinary production consultancy services is really driving improved earnings margins. So if we look for this area in 2.3% revenue growth, and that's really because of improved industry conditions that are occurring across the livestock sectors. But what's really important here is we're seeing some real improvement in our double-digit growth in our gross profit, and that's really because of this transition to higher value veterinary services, this increased use of our data analytics, as well as the rollout of some new vaccines, some new technologies, and other products that we've rolled out in FY24. So what I will talk a little bit about is one of those technologies relates to vaccines, and we don't talk a lot about this part of our business, but in FY20 we acquired a vaccine laboratory in Bendigo, and we've been investing in that over the last few years, and that investment is really starting to drive strong growth opportunities across not only our intensive animal business where it was traditionally servicing, but across our clinical vet services. So if we look at what we've done over the last 3 or 4 years, we've been able to get approval for 4 new vaccines. We've entered into a partnership with La Trobe University where we've developed a Japanese encephalitis vaccine, and we have a further vaccine that we expect to have ready to go in FY25. We've also invested in some next generation gene sequencing technology, which is enhancing the efficacy of our vaccines, and we're also using that technology to offer new services to the intensive animal industries, including antimicrobial resistance monitoring, which we're doing across the beef industry and starting to do in the swine industry as well. In the intensive animal business, we've also been developing some unique diagnostic testings that we're starting to commercialise across our client base. I think the significant part of this business over the last 6 to 12 months is we've been able to start to integrate this business into our clinical vet services, where we've been able to do some disease testing and surveillance for our clinics, and also to be able to expand some of the services in ACE around their grain and pasture feed testing for those dairy, sheep and beef clients. So really starting to see the benefits of the investments that we've made in this business over the last few years. As I said, our vaccines business continues to grow, and as a result of that, we've currently got a vaccine expansion project underway. We were fortunate to receive a grant of $700,000 from the Victorian State Government, and that's to build a new facility, of which we already have a planning approval, and we're in the early construction stage. So we'll be building that over the next couple of years. We're doing it on a modular basis to align it with growth in our sales of our vaccines. I'll now just give a little bit more depth into the financials of FY24. As I said, we had very good revenue growth, gross margin expansion, and that flowed through to EBITDA. One of the other contributors to that increase in earnings was the way that we were able to manage our costs. And On a like-for-like basis, we actually had a 2.5% reduction in our operating expenses, despite the inflammatory environment. And that's by really looking at the business and making sure that we're only doing things that add value. So part of that was a cost-saving program across our head office costs, as well as through some of the clinical vet services. We undertook a redundancy program in June and December 2023. We saw some of the benefits of that in FY24, but we'll see the full contribution of what we've done in FY24 comes through in FY25. What's really good about when you look at our P&L statement is that leverage that we're getting. Our gross margin increased from 65% to 67%, and then we're seeing expansion of our EBITDA margin, and our earnings per share increased from 1.3 cents per share to 2.76 cents per share. Just quickly on balance sheet, big focus this year in using those strong operating cash flows to reduce our debt, and we've been managing working capital extremely well. Our net debt came down from 71.1 million to 66.8 million, and that saw a subsequent reduction in our operating leverage from 2.9 to 2.6. As we mentioned, we've been able to generate some good cash flows. Our cash flow conversion to underlying EBITDA was 118%, and our operating cash flow was up 8.5% versus the prior year. And again, some of this is due to the slowing of our acquisition program and the cash requirements for that, as well as we opened one new site in FY24 compared to 3 in FY23. But as a result of that cash, the board is paying a dividend of 1 cent per share. With the record date was yesterday, and that'll get paid at the end of September. So just looking quickly at our outlook. So if we look at the organic growth strategy initiatives that we've got for FY25. In our clinical vet services, we've still got some upside out of our existing portfolio and to get the real synergies there. So we're continuing to ensure all our clinics in our network are working to meet our group target margins and getting them over 20% of EBITDA. We're also at the same time really starting to bring some efficiencies into the clinic to really prepare ourselves for that expected increase in companion animal visits as those COVID pets enter midlife in FY26 and FY27. We recently relaunched our Best Mates program to be able to extend that to a whole of life program. Up until a couple of weeks ago, that program was really aimed at animals just in their first 2 years of life. So we're now expanding that offering across the whole life cycle. We're expecting to continue to get the ramp up on our greenfield sites and our 4 restructured clinics, which we think will have a very positive contribution in FY25. And we've got some programs around some new products. There's a new once-a-year paralysis tick and flea product, an injectable product that's only available through veterinarians. That came into the market last month, so we've got a big focus on getting that out through our client base to really improve the compliance across the tick and flea programs that happen. And we're also launching a new program, Pro Livestock, into our farming clients and further expanding our Pro Dairy program in existing and new regions. When it comes to the intensive animal vet services, we're going to continue to leverage the investments that we've made in software technology over the last few years, expand that across more of our customer base, and extend the use of our data analytics system to enhance disease surveillance. We're also commercialising some new third-party software that will improve client production and profitability, as well as rolling out a unique new pharmaceutical product that's made by a European pharmaceutical company to enhance reproduction performance in the pig industry. And of course, with the investments that we've made in our vaccine business and the new expansion program that we've got in place, we'll be obviously further focusing on growth of our vaccine business. So really looking at a summary for FY25, veterinary services remain very resilient in the rural and regional areas, and in our case, it's supported by the fact that we've got both the clinic vet services model as well as our intensive animal model. We're expecting additional earnings growth in FY25. through the investments that we've made in the intensive animal side, as well as getting better performance out of our existing clinic portfolio, as well as seeing the full year effect of the ramp up of the new clinics, the restructured clinics, and the full year effects of the cost saving measures that we made in FY24. In terms of cash flows, we expect that to continue to flow through, and that'll be applied to debt management and growth initiatives. But at the same time, we're also continue to monitor the market for strategic acquisitions that we think can add real value to the company. So with that, Mark, I'll open it up to any questions.
Thanks, Chris. We've actually got one here from the audience. EBITDA to net debt ratio, is there a range that you're targeting there? I think was it in your slide from 2.9 down to 2.6? Are you trying to get it down to below 2, or what's the kind of board's current thinking on an optimal level for where you're at?
Yeah, I mean, our aim at the moment is to continue to reduce it. I mean, I think we'd like to have it trend towards more towards 2. Obviously, if we see some pretty compelling acquisitions, well, then that would probably that's going to increase that to some extent. But we think it'll probably the most comfortable area for us is actually if we're doing acquisitions, if we're continuing to invest in the business, it's probably between 2.5 and 3 times.
Okay, then another question here: what is a trigger for you to conduct more proactive M&A and consolidation? Is it getting the debt down a bit before you kind of retap that is kind of one angle, or is it what actually comes across your desk in terms of opportunities, whether that's owner operators who want to retire baby boomers, those type of vets?
Yeah, so our priority at the moment has really been to focus on the existing clinics, because there's still probably another 2% in EBITDA upside there. So if you sort of apply that 2% across our 150 million of revenue, then there's some significant upside we can get, but just by continuing to do what we're doing. In terms of acquisitions, yeah, look, I mean, we probably have a clinic come across our desk every week or two. We're pretty specific in what we want in a clinic. They've got to be a large clinic, but in the rural and regional areas, if you're going to attract vets and retain vets, you've got to have an appropriate supporting structure. For us, we think that's a minimum of 4 or 5 vets. So we're really looking for large clinics. Most of our clinics are large clinics, sort of between 5 and 20 veterinarians. And that provides, having that structure provides a good platform to be able to develop those people, give them the peer support that they want. And so at the moment, look, we've got several clinics that are sort of in the pipeline, and we're continuing to assess when might be the best time to bring them into Apiam. So, but we're also wary of the fact that we did want to reduce our debt a bit. And at the same time, we know that there's considerable upside in the existing portfolio.
And just maybe one for me on the maybe the 4 greenfields sites that you talked about. In terms of that ramp up, how long does it take from kind of building the facility to it hitting its straps? Is it a 12 to 36 month kind of timeline? I mean, I guess it depends if it's a new clinic in an area versus you're starting one because the community has grown and it can kind of support 2 clinics within the community. But obviously the new guy's got to or the new clinic, I should say, has to build up its reputation and its own customer base.
Yeah, that's right. So, the new clinics that we're doing, they tend to be greenfield clinics in new regions where there's, obviously population growth occurring. So rather than in existing regions where we tend to have the largest clinic in the region, they tend to be in new regions. So to give you an idea, the recent clinics that we've built have been in Caboolture on the Sunshine Coast, which is, a rapidly growing area. We've just opened one at Tarneet, which is it's virtually in the Melbourne suburbs. It's near Werribee. It's a very fast growing population growth area. What we have been doing with those greenfields is we've been co-locating them with Petstock, one of the big pet retailers. And again, that's giving us a bit of leverage from having the same customer coming into for their retail offering, having the vet there as well. I think when it comes to these clinics, we want to get them profitable as quickly as possible, and really get them profitable within 12 months, and then starting to see them really deliver the earning margins that we expect at 2 years. And so, we've done 6 or 7 of these now. Certainly the first 3 or 4 were learning experiences. We probably overstaffed them initially, and they took a bit too long to ramp up. So the last 3 that we've done, we've operated them on a different model, virtually just aligning those people resources with the growth in the clinic, and very similar to what they do in the US in a lot of those pet retail businesses that have co-located vet clinics. And so under that, we're certainly mitigating or minimising the losses that those have in the first 12 months, and trying to get them as profitable as quickly as possible.
We've had a few more questions. I don't know if we're going to get through all these, but let's see how we go, Chris. A perennial topic we've talked about when you've been on here before. Current environment for recruiting vets, and the kind of supply constraints there. I know it was particularly hard at the end of COVID, to get international vets to kind of relocate. So there was a lot of focus on, training people internally and, trying to get from the local market. But maybe just comment on, where that is given the previous inflationary environment.
Yeah, so you'll hear the veterinary industry as a whole still has a lot of issues around supply of vets. We don't seem to be seeing that at the moment. I would say in the last 6 to 9 months, we've seen a total turnaround, and I think that's probably some things that we did in terms of recruitment as well as our development program. So we launched a program called Your Vet Career Your Way, where we're looking at individuals and looking at how they want to operate and balance their work and their life. So whether that's around working a consolidated week, where we now have near on 80% of our veterinarians work a 4-day week or a 9-day fortnight. We give them a lot of flexibility around what part of Australia they want to live in, and we have many of our vets who will move between clinics or operate across multiple clinics. And I think it's that real focus on people and professional development that's got us in a position of where we've probably got one of the lowest, or I think we have one of the lowest turnover rates of vets in the industry. And so, yeah, from our point of view, we've got a couple of specific locations where it can be difficult to get full-time vets, and we'll use locums. But as a company as a whole, we really aren't having too big an issue with veterinarians. In fact, a lot of the recent jobs that we've advertised, we've had 3 or 4 or 5 applicants for those jobs. So we're pretty comfortable in terms of veterinary resources.
Okay, great. That's definitely, as we said, turnaround. If anybody goes back and watch any of your previous presentations, definitely was the same story 2 years ago. A question on current trading, July, August. How have we kind of started off the year? Is it more the same from FY24?
Yeah, look, if we look at July, it's very consistent with FY24. That's just similar, sort of around that 5 or 6% revenue growth.
Okay, perfect.
And we're only looking at a 4 or 5 week period there, but so far it's feeling fairly consistent.
And the revenue split across the business between the 2 divisions, I mean, we can say it's kind of 75-25. Is that something we kind of should expect to continue, or as the vaccine business ramps up, should it kind of trend, to be to maybe 30% or 35%? How should we be thinking of, the kind of the growth in the 2 businesses, just given that investment in the vaccine side?
Yeah, no, I think, that vaccine side, if you're looking at FY25, we'll continue to see growth in the clinical vet services. We've got a real focus on capitalising on a lot of those acquisitions that we'd previously made. We think there's still some really good growth there. So, if you sort of look at what do we think will happen over the next, 2 or 3 years, again, we're expecting that that clinical vet services will continue to grow and sort of push towards, maybe 85, even over the next 3 to 5 years, up to 90% of our business. So, we continuing to invest, significantly in that intensive animal side. But the reality is those COVID pets are going to flow through, and as a result, that spend is going to increase significantly over the next 5 years.
And then I think we've got somebody maybe based just out of Sydney. Have you got a location in Agnes Banks outside North Sydney? Or going to
Yeah, we've
open?
got an equine clinic we've got an equine clinic just based out of Sydney. Yeah.
Okay, there's a question on what's the plan for that, whether to expand it or kind of consolidate it into a larger practice, I think.
No, our plan for that is to continue. At this stage, we're continuing to operate it. We restructured it back at the start of the year, and we're continuing to operate that. It's operating under a different model to what it might have prior to us acquiring it. But we're really focusing on that becoming a very efficient clinic, similar to what we've done with all our other clinics in the portfolio.
And in terms of one final question, we're just waiting for Dennison to rejoin us here. In terms of the acquisitions, are you agnostic to whether they're? Oh, here he is. I'm going to quickly. I've started, so I'm finished, as they say on Mastermind. Are you agnostic to where the acquisitions come, Chris? Whether it's in the clinic services side or the more specialist side? If it kind of meets the hurdle rates, is that it? Or are you trying to focus on one side or the other?
I think in terms of acquisitions, our focus would be on the clinical veterinary side. That's where it's still a very fragmented market and where there's significant opportunity. If we look at our other side, intensive animal, we've got an extremely solid footprint across Australia, and so it's really organic growth where the opportunities are in that side of the market.
Okay, perfect. Chris, thank you very much for coming back and giving us an update. And we'll continue to follow the story throughout the year.
No worries. Thanks, Mark.
Okay, and we'll flip from Bendigo to Brisbane. Dennison, if you want to start sharing your screen, I'll let you know when I can see it coming up now. Yeah, I can see the cover slide of your presentation now, Dennison.
Great, thank you.
And your audio
that's all good,
sounds
Mark.
good
Can
as
you hear
well.
me too?
Yeah, looks good. Your audio sounds good as well.
Great. All right, we'll rock and roll. Look, thanks everybody. This morning we're just releasing our full year results presentation, which I'll talk to. We are going to, however, go into a trading halt just so that I could do this. We're just finalising a beneficial tax impact from our tax losses. A call was made late yesterday by our accountants and auditors that should be put onto our balance sheet. It priorly hasn't been. It was picked up quite late, frankly, in the piece by them, but it does mean in order for me to do this today, we'll go into a little trading halt for a bit, hopefully just for a bit of today, but certainly be back on Monday. But the results are otherwise as presented here. I'm really happy to deliver a result at the top, above the top end of our upgraded guidance. Underlying normalised EBITDA, if you included ADT for 12 months, is 34.8 mil. Actual reported adjusted EBITDA of 32.6 against the improved guidance of 32 to 32.5. So when we started the ADT journey, unfortunately, we couldn't get ADT for a full year because of the timing of when it fell in, and it is very much a fairly consistent business month by month. We made the comment we were looking to do 31 million of EBITDA 12-month adjusted. We upgraded that to 33.5 to 34 in May, June, going into the ACG and AAG acquisition and capital raise, and we've now delivered 34.8. So really pleasing for us to have delivered on our expectations, and that certainly is the style and type of business that we're aiming to be. We're in really good shape. Cash in the bank of $11.7 million. Actually, reported cash is 25.6 mil, but that was just immediately pre the payment out for buying AAG and ACG. So 11.7 million if you take that money out at June 30. What the effect of the upgrade or the better than expected underlying earnings has been that now when you include AACG and AAG into a full year's forecast profit, if we look at 2024 and said, what would you have earned if they had been included for that period? That now moves up to $40.2 million from 38.6. So as we look into FY25, we are now very much see ourselves as a $40 million plus EBITDA business. At this stage, we are rebuilding our models and doing our budgets as we have been integrating these businesses in, and they largely are integrated into our business now. And we will look to give guidance on that. The $40 million EBITDA number really is a before growth or before any sort of cost or improvements we can make to the business. I think right now, strategically, probably the most important thing is the balance sheet and the net debt in particular, and financing the business is in great shape. So with a net debt of $68.3 million against what's a pro forma EBITDA of $40 million plus, the EBITDA, net debt EBITDA ratio at 1.7 is very, very refinanceable. And in fact, through this entire journey post ADT, that has not been an issue. We're very much in a refinanceable range. What we needed to do is just really deliver these audited accounts, and we also need to push up against that guaranteed minimum interest period we have. The big goal, though, is to change the cost of finance from that ADT acquisition package, which was very expensive, which we had to take, was our only path to doing the ADT deal, not being able to hit the equity market at that time under the terms of the seller, to now a senior financing facility. So, for the rest of the points of the year, share prices obviously responded really well this year, which just reflects the actual underlying value of the business. Sitting here today at 6.5 times EV/EBITDA. At the back of this presentation, you'll see, we're actually cheaper now by 25% than we were before we actually bought ADT on an earnings basis, but we're still very much below global comparatives. I'll flip through this fairly quick today. It really is about the results today. But, we're a substantial business now, I think is the real point. We've got over 500 employees and we stretch the whole width and breadth of Australasia. So from the bottom, from Stewart Island in New Zealand, we have an office in Launceston, up to, the top of Australia as well. We look after over 200,000 customers, and it's a real job. We really do have an impact and play a role in secure and safety in their lives. In terms of the business, 81% of it's in Australia and 19% is in New Zealand. New Zealand business performed well last year, and what is, I think, an interesting thing to note in the regards of New Zealand very much is in a recession. And it just sort of shows the underlying strength of a business or defensiveness of a business like this. I won't spend any time today on our journey. We can trespass that another time. We'll go straight to the financials. So as called out, adjusted EBITDA 12-month basis, 38.4. I think the really key thing I'd highlight, though, here in our accounts, working accounts now, is the margin. And so we were sort of pointing, our aspirational target was to be in a 25 to 30% EBITDA margin range, which is a very good range and a very healthy range for a business like this. I was sort of pointing more to us tracking at 25% with the hope to get more towards 30 over time, which is still the way I'd probably see the journey. At 26.7%, that's a really, really, really good result, and represents a good business. Operating EBIT, we're up, we're well through $30 million if you include the ADT business for 12 months. And I'd also, of course, note that we're not including ACG or AAG in these accounts at the moment. These are historic accounts. The other notable features, though, probably in our accounts are the three lines towards the bottom. This year, as we had said, well forecasted and explained, we're carrying a lot of one-off costs, like a huge amount of one-off costs when you sum them. We've had 2 equity raises, 1 debt refinance. We've had all the due diligence and associated costs of that. We've paid effectively double costs as we've transitioned the ADT business off the Johnson Controls business, which those costs were done by way of a service contract JCI, which has ceased at the end of July. And so, $12.8 million effective, what we'll call abnormal line or non-recurring line. We very much expect to see that gone in the new year, outside any other corporate initiatives. And I suppose the debt refi we're going through at the moment will probably put that as a non-recurring next year too. But the quantum of what we've experienced next year will be nothing like this. The other lines are the finance line. I made the comment about the refi. I mean, the big goal is to get that down, and then the tax, where we have a benefit. And I think the big point here and what we're waiting on at the moment is just we have a large tax shield in our unrealised tax losses, which we can use over the next couple of years, which will stand us in really, really good stead. We won't actually have to pay tax for some time. In terms of working that through, look, it's pretty clear. This is just the breakdown of those abnormal costs. You can assess them at your own time, but that gives you a pathway through from the reported EBITDA off the accounts through to the underlying EBITDA to show, I guess, how we got that breakdown. One point I would make, though, is that the persisting accounting treatment that will sit with this business going forward is really the use of the way global accounting standards impact us. They impact us primarily because we acquired what is viewed as a customer base, more even than, say, an intangible. And so the value of ADT as a brand is actually only about a fifth in our books, the value of the customers that we apparently acquired with the transaction. And with accounting treatment, you have to depreciate those over 5 years. So we have this really large non-cash charge that sits in various levels, both in our gross margin line and our EBITDA line for the business, which is largely, frankly, not material in terms of the actual cash flow or the actual economics of the business going forward, but as accounting standards. And so here, what I've done is I've using the reported numbers and then the notes and the accounts, and you'll be able to do this yourself if you wished, I guess, posited the way we see depreciation from a management accounts point of view and amortization playing through the business. And so depreciation for us is really just related to where we need to spend money to keep the business going and maintain and run the business. So PP&E, core business CapEx, servers, etc. We also are including leases in that. We've had a big lease pickup because of particularly our Sydney building at Rydalmere, which we've inherited, of $2 million per annum, which will be in the books for another couple of years. Outside of that, the rest of the lines, the subscriber assets and tangible amortization, as I call it here, really are non-cash items that aren't recurring. And so once they wash through the accounts over the next couple of years, they will disappear, but they do have an impact. And so we need to make that point so that you can understand why we generate, really good cash flow, but you may not see such a strong bottom line profit for a couple of years at a reported level because of the way the accounting works. Balance sheet, strong. Again, really the point here is that net debt pro forma EBITDA of 1.7. So off reported numbers at 2, off the pro forma at 1.7, very much, focused right now on getting these results and audit out the way so that we can fully turn our mind to the refi work, which is underway and being run by New Capital, so that we can give you an update on where we expect that to go at the AGM on October the 8th. From a cash flow point of view, I thought it was important just to dig into that a little bit again, just to make this point about our strong cash flow. So operating cash flow of 8.1 this year, as you saw in our quarterlies, was stepping up as we got more and more control of our business as we transitioned off JCI. That big non-recurring cost we've incurred this year, as we had said, gave us an operating cash flow of 20.8. I'd make the point that when we bought ADT, we forecasted 17.2, which you'll see in the presentation from that time, August last year. So we've actually, beaten our actual cash flow numbers by over $3 million, which would, speaks to the upgraded guidance that we've given. Investing cash flows are really the acquisition and then this big CapEx line, which we will talk about shortly. The important thing again, though, to recognise is these cash flows represent last year, which didn't include a full 12 months of ADT, didn't include ACG, AAG, and has the non-recurring costs. And so when we look forward to FY25, you're going to see a really significant step up, and we are seeing and feeling that in our business now of cash flows. To just really, I guess, make the point around quality, I've done a breakdown here, taken our underlying reported EBITDA and actually built that back up from our reported operating cash flow to show that, the actual cash flow generated from the business, the conversion of cash flow of our P&L was actually above 100%. And so, it is very much a strong cash flow business. And again, we will see that more and more as we move out of this period of time. One point probably to note, which is largely immaterial, is we have been on a payment plan. So whilst we don't have to pay operating tax for some time with our losses, we have had a tax plan which relates back to the very early stages of the business. That actually concludes also in December this year, which will be great. CapEx is the big line. So if we look at the things that didn't quite happen as we wanted, CapEx was much larger than we expected going in. That really relates to, we inherited a lot of pre-signed up work, which we had to commit to, and they were under old contracts, or called ADT owned contracts, where they have to be reported as CapEx, and we had to deliver on them. We also had to carry the 3G conversion to 4G security systems this year, which were also under those contracts, and we also had to honour. And so we have had an exceptional year of CapEx. Since we have taken over the business, though, we have repriced our security systems. So we make a return on new systems that goes through the P&L now, not through the CapEx line. And we're actually ceasing ADT owned and effectively giving that historic equipment to the customers. We did that at the start of this new financial year. So when we look forward, the two line items of CapEx, really the only two that we really expect to impact us on a persistent basis, is the ADT medical business, where that is a leased product. We actually buy the equipment and then we essentially rent it to the customers for as long as they need it. And the return on capital there is really, really strong. And so it's a great business to be in. That business in the next year, the largest part of our care business is actually in our New Zealand business, and that does have to go through 3G. So we are calling out, there's probably a $5 million New Zealand CapEx number for next year out of what will come out of medical and New Zealand around 3G. Outside that, it really is stay in business or growth. And then outside of all of that, it's really just the general business CapEx. And last year at 2.2 mil, it was actually a little bit above expectation. It was above probably what I'd call normal, as we called out in the depreciation line. Core business CapEx is really around $500,000 to $1 million, which is computers and servers and cars or what have you. Last year, we refit all our offices. We took over ADT, we painted them, we moved a number of offices around as we moved in the footprint, so it was running a bit hot. So next year's CapEx will be very much single-digit millions, and that is the sort of recurring rate, which also will include, growth in medical. So in terms of the accounts and where we are, we're very, very happy to have outperformed, I guess twice on our guidance, to have ended the year with an incredibly strong business, but also a business that now has real clarity around itself and operations. And to be honest, as much as we can reflect on all the things that have happened in the last 12 months, they are in the past, and we're actually in a very calm place now, and we're focused on execution. And so from a corporate point of view, the key is to keep driving cash flow. We will be down at that net debt to EBITDA of sort of 1.5 times as we look forward into the new year. We are going to refinance our debt, which puts us in a great place to to consider capital initiatives, to look at growth initiatives, to really put the future in the hands of the business in a way that it hasn't sort of had the benefit of being in its journey to this point. So that corporate strategy remains. And in terms of our growth areas, and I won't actually spend any time on this today because we have talked about it, but the three growth areas are commercial and enterprise. We've gone from a $2 million per annum business in August last year to one that does more than $40 million of revenue today, off the back of both organic growth, where we were run rating $12 million out of ADT from the $2 million, and then the acquisitions have added on top of that. The residential security area, where we've been moving the customer growth and really offering a completely new service to customers around easy installation, where they can choose if they wish to install security systems themselves, or we can still do it for them, but it does improve the price point and also, I believe, the product that we're offering, and that is starting to come through now. ADT Care, where we've done a lot of investment this year in staff and re-signing contracts and getting accredited by NDIS, and getting engaged in some of the government programs again to set the scene for growth and for that business to emerge into what is a increasingly bigger and exciting growth market for us. And then finally, really the essence of this business and where we started our journey, being the current executive and board team, is around video monitoring and connecting new devices and IoT devices to our 4 operating centres. And I'm really, really happy to note that, in our IMS business, we had a 650% increase in cameras or connected cameras into video monitoring this year, which is still, to be blunt, really scratching the surface. And so this year we're finally in a position, we think, to really start to drive camera monitoring penetration, which has a really positive impact on ARPU and customer life. And so looking at 24, as I said, really significant year by anybody's stretch. We've ended the year having achieved a lot, but having really created a very clear and straightforward business with very clear growth areas and a really focused team, which I'm really proud to be part of. Looking into next year, it's all about leadership, and so what's really important now is we have this national coverage of people. So I know, 96, highly qualified security technicians in Australia and 40 in New Zealand. That really does set the platform for us. That is a key comparative advantage where our big commercial customers are looking to be able to lean in. We're very open to technology. We've got, a leading operating platform in our business that allows us to integrate lots of new technologies and solutions. And we're really focused on improving supplier relationships. We want to be the lead player amongst our suppliers because they give us good terms, but they also bring work, and we can work together about, solutions in a way that, we think will be really constructive for customers. We're going to continue to improve and simplify in the back of the business, which you probably won't see so much, as we are very set in what we're doing up front. Get the debt refinanced, and then stay open to opportunities. And we're very much aware of the risks of M&A. To this point, we've been very focused and strategic in what we've done, but it has, we believe, proven to be valuable for us, and has actually created value. So we'll just stay open to what may be put in front of us. Wrapping it out, if you really look back to the prior to ADT journey, so prior to August last year, we were a sort of 16 mil market cap business. We're nearly touching up to 200 mil today. Our debt's a bit high, but nowhere near as proportionally to our earnings and value. The ironic thing I sort of point out, I guess, is that, our EV/EBITDA, which is just much, much higher quality and safety today, is still, a quarter lower than what it was back in the day. And then, of course, our gearing is very much in a standard range now. So, we're quite comfortable in certainly as being investment people ourselves, in the financial thesis around this business. And we see, a lot of opportunity to continue to build shareholder value as we go forward. So I'll pause there, Mark. I've pushed it a bit long. If there's any time for questions, we can maybe quickly grab them.
That's fine, Dennison. We actually started a bit late, so we're probably bang on time. We have a couple of questions already, so I'm just going to take these two. One on churn rates, if you can comment on that, and if possible, split them out by resi and commercial.
Yep. So look, commercial, in our presentation, I skipped through it. Commercial has lower churn than resi. So commercial relationships tend, certainly as technology, and when I'm thinking commercial, it's I'm not talking about a little bookshop, in some suburb. That they can fit that. That's really SME to us. I'm talking about, significant commercial relationships. With technology now so integrated, they last for years. So I think there's a slide back here that calls out our relationship, average tenure of 10 to 15 years. And, that's frankly because they haven't moved. So that probably keeps rolling forward as we go forward. In Resi, there's a lot of change going on in Resi. So with the 3G project, you did have a batch of customers that didn't pick up new systems, and then you had your normal underlying. Underlying churn reflects people moving properties, frankly, and then whether they re-sign. And so for us, that's been very consistent at around 10%. Sort of gross, and then obviously you look to make that up. A third of people that move house re-sign, straight away in a new house. And I think as we bring in DIY technology, which actually allows you to port, your equipment with you if you want, that will improve. And so churn itself has not been notable, is probably the best way I can put it. What we're really focused on, though, is improving our service, which we've done with the integration of the ADT Resi business into Signature. So the turnaround times are faster, our responsiveness to customers is faster. Our underlying monitoring responsiveness has always been very, very good. I'm really talking about the customer response around a customer issue, billing, etc., on-offs. Has all improved, and that's our best churn mitigant. And so really what we're focused on looking forward is growth. Now we want to see net adds coming in, and we want to look to grow the customer base, reasonably this year, but in an accelerating fashion as we look to the future.
And that leads nicely into our next question. Acquisition costs, especially maybe for the monitored services portion of the Resi business.
Yeah, look, we don't have a really clean metric on that, to be honest, because we've got a marketing budget which is reasonably substantial, and then we have not a lot of human resource, so we haven't got to a point of a CAC in residential yet. We fully charge. We understand the returns on a new line, if you like, or a new customer. But I probably don't have a metric that you can use to compare to offshore players, which is probably what people are looking for. We really run the business for cash and cash profitability. And so for us, it's around getting the product pricing mix right, such that as it flows through our shared costs and our product costs, we actually get a return. And so our goal is to get about a gross margin of 30% off new sales. And then obviously we get higher gross margin off recurring sales. And so it's not a good answer, but it's one where, we will take it on notice. I think we'll be in a position in the next year to get a lot more analytical around it. But at the moment, we focus on profitability per customer and profitability per new customer at a cash profitability level.
Okay. And then just a question in terms of, net debt to EBITDA. I know you said, the refinancing still has to happen, and new businesses are going to come in, and that's going to change the EBITDA figure in that calculation. But if we think long term, like kind of more broadly, is that 1.5 times that you kind of mentioned here, is that kind of what you think long term the business should kind of operate at, or should it be kind of, given the cash generated nature of it, should it be kind of higher, supporting 2.5 times?
Mark, I'm a stodgy guy, and look, the reality is companies get pushed around by the latest trends, and the trend at the moment is to de-gear because that makes everyone excited. If you had done this 5 or 10 years ago, people would say, why are you only at 1.7 times? Because certainly the banks will lend a lot higher, and acquirers would gear it a lot higher. So it's a little bit around, it's a little bit of political, the reality is it's a very stable business that generates a lot of cash. So, choose your own adventure. My best sense of it, and I'm not particularly good politically, is I think a business in these conditions at this time with around 1.5 feels about right. If you're an academic financial person, you'd say it should be probably more like 3. If you're a PE and you wanted to back yourself in, you'd make it 5. And off you go. But I think, look, we very much, I guess to reverse it and put it a different way, we very much want to become over time seen as a mainstream, small, then hopefully, mid-cap company. And I think in industrial Australia, a leverage ratio of around 1.5 is perfectly sensible. And then obviously for the right things, you might gear it up a little bit, maybe to 2. And you use your cash carefully. The other thing, though, the unknown thing is just conditions. And so, look, if the world falls apart, our business is very, very stable. And I think the New Zealand business really pointed that out this year, trading through recession, but with an EBITDA up 11%, that we'd be in a good position for capital management, maybe buybacks or what have you. So I think it's going to be a little bit of an adventure, but we said when we bought ADT that we were aiming to get to around 1.5 times, and that is what we have been doing. We're focused on delivering to what we say, and we're very much in line to that. Where does that go long term? I think it probably is around that level, and we stay there unless we get feedback or conditions change otherwise.
Okay. Dennison, we have finished bang on time, even though we might have started a minute or two late. And given your trading halt tax issues, which are on the positive side, I'll say, not to confuse anybody. I don't want to take up any more of your time this morning. I'll let you get on to those. And thank you very much for coming.
Appreciate your time. And look, sorry for that around the market. We'll hope to quickly remedy that. Hopefully this today, but a very positive set of results, very positive tone in the business, and a lot of great conversation. I'm really excited about turning up again, Mark, and continuing this journey with everybody over the next year. I think it'll be a bit of fun, which will be nice to have in a world like this. So looking forward to it.
Yeah, we need a few good stories, and we'll definitely get you back in a bit later in the year. So Dennison, thank you very much. Right. And we'll switch from Brisbane, continuing our round the grounds this morning, back down to Melbourne, where we've got Paull, Gillespie, and I see we're joined by Richard Ludbrook, CFO as well. I'm not sure who's sharing the presentation. Paull, are you sharing yourself, or is Richard doing it?
Actually, Richard, would you mind doing that? Because I've got the stuff on my machine. If you're able to share, that'd be great. Sorry, Mark, slightly disorganized this morning.
I'll let you know when I can see it now. Yeah, Richard's getting us going here now. Yeah, I can see the cover slide now, so you can take it away, gents.
Okay, lovely. Thank you, Mark, and good to see you, and good to see the number of attendees in the call today. So it's good news. We're at the end of our roadshow. We've been on the road. We announced on Monday, so I reckon we've seen probably, including all the desk briefings and all that good stuff, I reckon we've seen over 200 people this week. So it's been an incredibly busy roadshow for us. But what we'll do this morning is take you through some of the highlights of the deck, and then Richard will take you through some of the financial detail, and we can open up some questions after that, if that's okay. But I'm conscious we've only got 30 minutes, so we'll get our skates on right now, Mark. So I guess if we just look at this slide here, as we can see, we're pleased to deliver another set of record results. We've delivered 28% growth in adjusted EBITDA and a 40% rise in free cash flow. We've delivered strong growth in our UK, New Zealand, German operations. We've completed 2 acquisitions to build scale and we've expanded into a new attractive territory, which of course is Denmark. As I've said before now on many of these meetings this week, SPZ is a fast-growing, profitable and cash flow positive company that can scale in large markets and self-fund its organic growth strategy. So if we compare with the PCP, revenue's up 21% to $54.3 million. Adjusted EBITDA is up 28% to $14.7 million. And margins have expanded by 150 basis points to 27%. We're managing our profitability, driving margin expansion, and self-funding our growth investments. We generated $12.2 million of free cash flow. Including acquisitions, CapEx, and technology investments, we spent $13.5 million and closed the year with cash on hand of $7.2 million. The growth investments included $600,000 of setup costs in Denmark, where we started to generate revenues soon after setup due to some early contract wins and some great new hires. We spent $5.2 million on growth capex to support our organic expansion and a further $7.7 million on the 2 acquisitions in the UK and Germany that added scale and earnings. It was a heavy investment year, which will set us up well for FY25 and beyond. If we go now to slide 3, please. That's it, perfect. It's a good question to ask, what's actually driving these record results? Well, if we put it simply, it's a continued disciplined execution of our growth strategy. We've said for many years that we know what we want to achieve at Smart Parking, the team gets the job done, and everyone pushes the business forward in the same direction. Our strategy is to drive strong organic growth in existing territories, build scale in new regions, and complement this with selective acquisitions at accretive prices. We delivered revenue growth across the group, with the UK up 21%, New Zealand up 56%, and Germany up 519%. The increase in sites under management is a key revenue driver. We closed FY24 with 1,424 sites under management, which is growth of 28% compared with the PCP. The estate of sites has grown at a CAGR of 31% since June 2018, and we have a clear line of sight on achieving our target to have over 1,500 sites under management by December of this year. This target seemed very ambitious when we set it, but there is now a strong prospect of us delivering on this number well ahead of time. So what's next for us? We certainly expect further growth across all of our operating territories, but we're also now able to look to optimize our portfolio in order to enhance our yield. The PBNs increased by 22% on PCP. We averaged 214,000 PBNs per quarter this year, which is an average increase of 22% on last year. The UK accounts for 78% of our PBNs, with 15% in New Zealand and 8% in Germany. We expect the mix will continue to balance as the territories expand. During the year, we integrated the local parking security acquisition in the UK and the Park Innovation deal, which we completed in Germany in July 2023. We will continue to make disciplined acquisitions to supplement our strong organic growth. Added to this, we are in advanced negotiations to establish a $10 million debt facility to provide additional capital as and when these opportunities present themselves. We commenced operations in Denmark in February and have already started issuing PBNs and generating revenue. We can talk more of this successful case study later in the presentation. However, it's a great example of how we can leverage our market-leading technology, deep domain expertise, and execution capabilities to quickly and successfully enter new territories. It sets us up very well for entering potential new markets in the near future. And since we last reported results, we've made good progress researching and evaluating some of these new opportunities in Europe and the US. We spent a lot of time on the States in particular. We've invested in understanding the regulatory frameworks, site owners and their needs, and the incumbent providers. There is more work to do on this, but I will say we have significant interest and we're firming up the business case for a carefully controlled market entry. And finally on this slide, before I hand over to Richard, I'll call out that we've started FY25 strongly. July revenue is $5.5 million, which is up 34% on the prior year. We have many more sites generating revenues and higher quality revenues given the broader geographic mix across the estate. We expect FY25 to be another year of profitable growth and positive cash flow. So it's encouraging we've started the year as a record month. If I can hand over to Richard now for some financial detail, then we'll continue with the presentation.
Thanks, Paul. Can everybody hear me and see the P&L?
We can, Richard. All looking good.
Brilliant. Thank you. Okay. All right. So thanks, everybody. So as Paul said, we achieved record adjusted EBITDA of 14.7. Revenue was 54.3 million, excluding revenue in the new Denmark territory, and interest income is up 21% on the prior year. And this was a result of a 22% increase in parking breach notices, driven by organic growth in sites under management across all territories, with the exception of Queensland, where we have operations paused, and the contribution from the new acquisitions. Overheads are up 16% compared to PCP, and this is a result of increased activity, ongoing expansion in the newer territories, and the acquisition of Park Innovation and Local Parking Security. The adjusted EBITDA margin increased 150 basis points to 27%, which is pleasing given the newer territories are margin dilutive. Depreciation and amortization increased following the installation of an additional 302 organic sites and the D&A related to acquired businesses. The company incurred a tax expense of 1.9 million compared to a tax benefit of 0.2 million in FY23. FY23 included the benefit of tax losses for companies in the UK and New Zealand, and the UK is now in a tax-paying position. The net profit after tax and the basic earnings per share were impacted by the adjustments to EBITDA, the higher D&A, and the $2.1 million increase in the tax expense. In terms of the revenue growth, the UK parking management revenue increased by 6.4 million or 21%. The UK company restructured the sales team in early FY24. We saw the benefit of this in the second half of the year. The UK business added 75 sites in H1 and 109 sites in H2, bringing the total UK sites to 1,124. And the strategy of growing the number of customers with multiple sites is proving beneficial. In the last 3.5 years, the company's established parking management operations in New Zealand and Germany, and both of these businesses are performing strongly. Revenue in New Zealand of 4.6 million increased 56% on PCP in New Zealand, and Germany, excluding the acquisition, contributed revenue of 1.4 million, up 215% on PCP. The rate of site growth in these new territories is accelerating, with New Zealand and Germany adding 118 sites in FY24 compared to 89 in FY23. And Australia, up until the pause in February 23, was growing strongly. While the company continues to enforce manually on Queensland sites, revenue reduced from 1.4 million to 70,000 in FY24. The two acquisitions contributed revenue of 2.6 million in FY24. And just a reminder that we acquired Park Innovation in July 23, and that's a manually operated German parking management business, and Local Parking Security, a UK parking management business that includes 68 number plate recognition sites and a portfolio of manually operated sites. As Paull said, July 24 revenue was a record 5.5 million, up 34% on the previous year. Okay, turning to the cash flow. So the company generated record adjusted free cash flow of 12.2 million, up 40% on FY23. And the strong cash generation and cash reserves have enabled the business to invest, which will lead to future revenue and earnings growth. The company made a substantial investment in future growth with $12.9 million spent on CapEx and intangible assets and the acquisition of Park Innovation and Local Parking Security. And just a reminder that CapEx isn't included in free cash flow as it relates to future growth rather than maintenance CapEx. Overheads of 22.8 million included 1.3 million related to businesses acquired during the year. Excluding the two acquisitions and the Denmark startup, the headcount grew by 5% in FY24. So total headcount for the group is now 231, and that does include the headcount from acquisitions and Denmark. Okay, so this slide shows that the group maintains a strong balance sheet and is well placed to fund organic growth, expansion into new territories, and further acquisitions. So as of August, the company is debt-free. Annual repayments, including interest, were approximately 1.1 million. And as Paull said, we are in advanced negotiations to establish debt facilities to fund international expansion and complementary M&A. Now I'll hand back to Paull.
Thank you. Okay, if we go, yeah, this slide here, thank you. Oh, right, so if we look at slide 13, which is the one on screen right now, at Smart Parking, we're planning for long-term growth. We have a great opportunity, significant competitive strengths, a highly capable team, and the ambition to succeed. As we show on this slide, we have multiple growth drivers. We feel we're at the forefront of driving industry change, raising standards, and delivering better solutions for site owners. Our opportunity is to scale quickly and entrench ourselves as the leading technology provider of parking management solutions across major markets. We can scale through these three growth vectors. We can build share in our existing territories by displacing legacy providers with archaic systems. We're demonstrating this capability in both the UK and New Zealand. We can leverage this expertise into new territories such as Denmark and Germany. We look for a constructive regulatory environment, legacy-style competition, and an ability to deploy our technology advantage. There is scope for this for many years of growth in both Germany and Denmark. For example, we can take these capabilities and learn. We can also take these capabilities and learnings and expertise into new markets. I have to say, the more time we spend researching opportunities, the more markets I see that are open and viable for us. For example, there are around 40 states in the US that are potential growth options for us. If we just look at two of those, in Texas and Florida, each one is a significant market with huge opportunity. Our task is to be careful, considered, and selective, and to manage execution risk well. We have a track record of doing that, so we can stay true to our playbook that has worked so well for us in the past. And we can supplement this growth with accretive acquisitions. It's a question of capital deployment, speed to market, and risk-adjusted returns. We have a capital-light model, a good balance sheet, and will continue to ensure expansion is low cost and risk-averse. Ideally, we'd enter the US market with a small acquisition to provide a base we can grow from. We'll be patient and careful, and we'll continue to evaluate the opportunity and how best to add value for shareholders. If we look at the next three slides now, 15, 16, and 17. These operating metrics, these are the operating metrics that we update shareholders with regularly. As highlighted earlier in the presentation, we're seeing growth across all metrics. To me, these slides highlight the importance of an effective sales strategy and execution-focused operational teams. As mentioned earlier in the presentation, the business model is simple. Win the sites, operate them effectively to create the PBNs, generate revenue, and manage costs carefully to drive operating leverage. We can then reinvest the cash flows at a high rate of return in order to maintain market position and our technology advantage. On slide 16, thank you. This shows that we can generate consistent growth and succeed in multiple markets. We have the ability to open a new territory and generate revenue quickly. We're conscious of not overextending ourselves and risking execution. We have built operating systems, infrastructure, and bench strength to manage this risk. We are well placed to scale. On slide 17, this shows the scalability coming through and the increasing geographic diversification of our revenue mix. This reduces the risk to any one regulatory environment and improves the quality of our revenues. Moving now to slide 18, this shows more detail on Denmark and provides somewhat of a case study. It's fair to say that we're pleased with the start we've made in this territory, and we're looking forward to discussing the progress in more detail as we move through FY25. However, as mentioned many times, Denmark has a good regulatory and commercial environment for SPZ, and we're confident this will be a successful market for us for a long period of time. Slide 19 provides an update on the regulatory situation in both the UK and Queensland. If we take Queensland first, after a roundtable discussion with the Minister and the Department for Transport and Main Roads on the 26th of June, there was a commitment to draft a code of practice based on the UK code, which will be reviewed by the Minister in September. As we've said many times, we are committed to work with the Queensland Government and the TMR to support the implementation of a new code of practice that will raise standards in the industry as soon as possible. And in the UK, we're having positive, ongoing dialogue with the new Minister and Department responsible for parking. From the 1st of July, the British Parking Association, the BPA, and the International Parking Community, the IPC, have come together to provide a single code of practice. We strongly support this code. It is designed to raise standards in the industry and bring both industry associations into line. The new code has been well received by the department and also has attracted significant positive media interest. If we move now to slide 20 in the final slide, I'll wrap up with some comments on our FY25 priorities. As I said, we expect another year of profitable growth and positive cash flows. We've started FY25 strongly with 34% revenue growth in July versus the PCP. As of today, we have 1,465 AMPR sites under management. So you can see we've continued our growth momentum since the end of the financial year. Our short-term focus is to deliver 1,500 sites by the end of the year. We want to demonstrate again that we do what we say we'll do. We have good forecasting clarity in the business and we execute well. When reflecting on the bigger picture, we are at something of an inflection point in the business, and the board and management recognise we're entering a new and larger growth chapter. As well as continue to grow in our existing territories, we're well placed to selectively expand into new, larger markets.
San Francisco. Could all remaining customers please?
Sorry, Richard's at the airport. I'll start that again. So reflecting on the bigger picture, we are at something of an inflection point in the business, and the board and management team recognise we're entering a new and larger growth chapter. As well as continue to grow in our existing markets or existing territories, we're well placed to selectively expand into new, larger markets. Building scale in multi-markets will significantly broaden our base, strengthen our business, and increase our earnings power. With less than 1% capture of the total addressable market and the timely opportunity to expand the TAM elsewhere, we have years of growth ahead of us. And finally, we will continue to complement our organic growth with disciplined and selective acquisitions. We can consolidate the industry, raise compliance standards, improve outcomes for site owners, and generate good returns for our shareholders. With our balance sheet and positive cash flow, we're well capitalised to take advantage of organic and inorganic opportunities as they arise. So that concludes our deck, Mark. So any questions you have, it's be great to answer them.
Okay, perfect. Thanks, Paul. And when you said you're on the road show, we definitely know now you're on the road show.
Yes. Well, we've been here on it all week, and Richard's escaping Melbourne today and heading back to Auckland. So yeah, it's been a long week, but that's good. It's good fun.
Okay. Just a question on the 1,500 target. I mean, that was a target that you guys put out, I think 3 years ago, maybe if I remember, as kind of a medium-term target, and there might have been slight revisions here or there to the upside, I would say. You know, are you thinking of, putting out a similar target? I think it's a good number that kind of people can, easily track to and, kind of somewhat model off of, if I can say that, so when we get to, the half year result now in February, should we be expecting, a new medium-term target to on that site number?
Yeah, I mean, I think you're right. We actually released a number, I think you're right, about 3 years ago, which is 1,000 sites under management, right? By, I want to say June 24 or June 25, 23 maybe. We then increased it at an AGM a couple of years back because we could see we were going to really smash that number. So we increased it to 1,500 sites under management by June 2025. And then at the AGM last year, we brought forward that number to December 24. Okay, so we revised that number, sooner and sooner, if you like, or made it bigger and then brought it forward several times. Will we release a new number? Probably yes. I suspect we'll exceed the 1,500 sites at some point during this half. I suspect before the AGM would be, the way we look at it at the moment. So really, that would be the plan, to come out at the AGM and talk about that number again and reevaluate where we're going and reevaluate, the number we want to get to. But yeah, we're absolutely want to continue to push that number up. We believe we can get to a much larger number. So, but we're going to continue to reevaluate and communicate that with the market.
Okay. And
we are seeing an acceleration in the growth of sites that we win. So, in the new financial year, we would expect to win between 200 and 240 in the UK, between 80 and 100 in New Zealand, and another 100 between Denmark and Germany. So that's quite a lot more than previous financial years.
Okay. And then another question, maybe Richard, maybe if you want to take it, we had Dennison on here just before you guys joined us, and he called out the recession in New Zealand, but as yet has kind of had no impact on their business, and just looking through these slides, it doesn't seem it's like really impacted smart parking either, but just given the poor economic state in New Zealand, maybe just comment on, have you seen kind of any effects flowing through as yet?
No, we haven't. Look, we obviously monitor our payment ratios extremely closely, and we haven't seen any effect at all.
Okay, perfect. Paull, you're just talking about the US, and I know we actually talked about it the last time you were on here, and you say there's kind of 40 states in the mix. I'm just curious on the 12 they're not in the mix. Are they, just because they're too small? Places like Wyoming, the Dakotas, low populations out in the Midwest, or is it? I remember you saying, it's about can you actually get access to the DVLRs in the specific states to actually, have their home address posted out the fine tune, follow the actual, process for actually getting these PBNs paid. Maybe just on the 12 states you're not looking at, maybe just comment on why they're not attractive.
Well, that's exactly right, what you said. I mean, essentially, the first thing we look for is the regulatory environment, all right? So, we know that our technology, when we implement it, into a solution that's been manual, if you like, in the past, or there's no kind of parking operation there, we see a big uplift in revenue. So the technology settings, the way we operate, the way our technology makes us different, means that we need to be able to access the DMV or the DVLA in the UK or Motor Check in New Zealand, for example. So if we can't access that data for whatever reason, then yes, there's no point in us going there. So, and that's exactly what's happening in those other states that you mentioned. And whilst you can access the keeper details across 40 states, there's less than that really that are very interesting to us. So I call out Texas and Florida. Well, the reason we call that out is that both of them have a kind of, well, Florida in particular has legislation in place that says, yes, as a private parking operator, you can access these keeper details. This is the way you do it. These are the rules of engagement. This is how quickly you need to send the breach notice out, how it gets paid. This is what the signage needs to look like. There's like I say, almost like a code of practice that is in legislation, which is fantastic for us, right? Because it is basically, it says your technology is going to work here, right? So that's number one. So we like that area. Texas in particular, again, it's common practice for parking operators to access the keeper details, but most of them do so via a manual situation. They're issuing tickets by hand. If they don't get paid, they then follow up to the DMV. And that seems to be quite commonplace. Not many people, very, very few competitors right now are utilizing similar technology to us. So we see it as a great opportunity, right? But we're also, we're keen, and I've said this, and this is not a market number, we haven't guided on this or whatever, but internally, our objective is to get to 10 territories operating, right? So that might be 5 in UK and Europe, or a few in UK and Europe and APAC, and then in the US, each territory is different, as in each state rather. So we would treat them as separate territories. But if we look at just Texas and Florida, there's 50 million people just in those 2 territories. In order to get to the same reach of size of market, I'd have to enter Austria, Switzerland, Norway, Finland, and probably Sweden as well, right? In order to reach the same size of market. So we believe that in the US, places like Texas, Florida, Washington State is very interesting to us because it has good rules or good regulatory environment. So all these areas are very interesting to us, and we feel that we can make a real difference with our technology. We've had a few research trips over there that have been that essentially proved out what we're thinking. So now we're at the point of just trying to get the right opportunity, the right asset to look at that we can make that market entry and create smart parking US, which is what we're after.
Okay, great. And then I just want to touch on margin expansion for a second. You know, GP margins, you know, as you say, you know, you build out, you know, maybe at a US territory here, you know, Denmark gets like properly up and running. Germany, you know, comes on another bit. I know it's on a low base, but I mean, those are big numbers on that slide from well, big percentage numbers from a low base, but you know, the total addressable market there is 90,000. You know, should we expect in the FY25 year to kind of see more benefits of that scale coming through in terms of GP margin, or how are you thinking about that in terms of entering new margins plus growth?
Yeah, so we would
Well,
expect to
clearly,
see.
sorry,
Sorry,
you
you go,
go.
Paul.
Go ahead. No, you go
We
ahead.
would
Go ahead.
we would
Go ahead.
expect to see continued margin expansion, you know, as the likes of Germany and Denmark become less of a drag on earnings, and you know, New Zealand has a very high gross profit margin. Denmark will actually have the highest gross margin of any territories that we have. The ticket value is significantly higher, and the cost to actually send out a ticket are extremely low. So yes, we will see ongoing margin expansion. And then I guess the only other thing offsetting that is whether if and when we enter new territories, they will obviously then be a drag on earnings.
Yeah. And Paul, maybe just coming back to you to round out the last time you were on here, I asked you to pick what was you know, the market you were most excited about, and at the time you said Germany. Is Germany still kind of the most exciting one as we look now? Forget about let's, you know, entering new markets, but the five on this slide, is it still the most exciting one if we in terms of, you know, growth opportunities and you know, capacity to dislodge existing players, maybe?
I think it's like asking which is your favorite, which one is your favorite child? Yeah, Mark. But look, I think Germany is absolutely the right place to be, and it's been quite challenging. If we're really honest with ourselves, and we've been saying this all week, right? It's a hard place to do business. Okay. But it's enormous. The market opportunity is huge. So it does remain very exciting to us just from the scale that we believe we can achieve, right? So, and also the long-term nature of it. So if we just think about, you know, looking at the sort of current situation, it's the biggest market. We've, you know, made some changes there in personnel to try and accelerate that growth. So I am excited by what we can achieve. But that said, you know, Richard sort of highlighted the fact that Denmark is got a wonderful regulatory environment, a great commercial environment, and will probably be significantly more profitable than the other territories, you know, once we start gaining some scale. So, you know, that's exciting to me because I think it can be a very profitable business. As you know, get to 100 sites plus, you're going to see a, you know, really good looking, great contributor to the group. Germany's going to take some time, but the scale is enormous, right? We just have to think differently there in order to grab market share. And then, you know, just look at the other markets. UK is the core, it's delivering, it's doing what we wanted to do, and we've still got a long way to go, right? So we've got growth for a long time. And New Zealand's kind of been the superstar, you know, the first one we sort of went offshore with, and it's started to generate significant revenues now for us and is very profitable. So I'm excited by them all, but I do think Germany's got that kind of, you know, the size it can be is an interesting bit. You know, they all bring different sort of attributes, but the scale that we can achieve in Germany is what is of real interest to us.
Okay. Gentlemen, we'll leave it there. I don't want Paul to miss his flight there, or indeed Richard to miss his. Thank you very much for coming back on and joining us. And yeah, hopefully we can get you back in for an update at some stage later in FY25.
Beautiful. Yeah, thanks, Mark. Really appreciate it.
Thanks, Paul. Thanks, Richard. And thanks, everyone, for joining the call. And we'll be back next week. We've got 8 more companies presenting next week across Thursday and Friday next week. So please do look out for those invites. They're gone out and we'll be rebroadcasting them on social media. And with that, I wish everybody a good rest of their Friday. Thank you.